Welcome, ladies and gentlemen, to another segment of the Trader's Edge. Today we're going to discuss using Treasury futures to capture changes in the U.S. Treasury yield curve. First, a quick disclaimer: futures trading is not suitable for all investors. It involves the risk of loss, so we must do our homework. So this slide depicts the yield curve, and it depicts the yield curve, not only that, but also the products that the CME offers to allow people to take advantage of opportunities trading the yield curve. You can see the 10-year note, the 5-year note futures, the 10-year note futures, ultra 10-year note futures, classic long bond, and ultra bond. They can all be traded in various permutations to take advantage of shifts in the yield curve. We also have short-term interest rates, Eurodollar futures and 30-day Fed fund futures. Eurodollars are a short-term interest rate product, but you can trade them out 10 years. There's literally more than 40 expirations going 10 years out. So the yield curve is available for any type of strategy depending on where you expect a shift in the yield curve. This next slide depicts, it's from the Federal Reserve Economic Database. It's a very interesting chart. It shows yield curve changes over the last 5 years. And you can see back in late 2019, the yield curve flattened and actually went inverted for a day or two. It's quite interesting. But since then, since late 2020, it's really started to move upward and steepen. So the 10-year yield has gained over the 2-year yield. The 2-year yield is basically nothing. With the zero interest rate policy and all the money printing, short-term interest rates are exceedingly low. Whereas the 10-year note, the 20-year bonds, the longer bonds, the ultra bonds are gaining in yield. And right now the yield curve, the shift is up to 152 basis points. There's a difference of 1.52 percentage points in the 10-year yield versus the 2-year yield. So, can traders take advantage of this? Well, before we get into that, let's look at, will it continue to steepen? And let's look at how the prices look here. So we have the 10-year note versus the 2-year note. This is basically CME Direct. It's a front-end system. You can get quotes on almost any system. So this is just one way of looking at it. But you can see there in the red rectangle, you can see the bid and offer spread in the 10-year note and the 2-year note. And you can also see the top of the order book, the quantity of the bid. So it's 132 and a half 30-second bid on the 10-year note, 132 and 1/32 offered. The quantities, 676 by 3,382. Pretty liquid. If you wanted to do a 500 lot, you can do it and not move the market given those conditions. The 10-year note is trading at 110.12 and 110.12 and 1/8 of a 32nd. And it's 18,000 by 92,000. So if you wanted to do, 15,000, 20,000 contracts on the offering side, you'd be able to do it. That's how liquid the Treasury complex is. It's just incredible. The only thing you need to get the hang of, though, is the tick values, the tick changes in the Treasuries, because they're a little bit different for all the different Treasuries. The 10-year note moves in half of a 30-second. The 2-year note moves in 1/8 of a 30-second. So it's a little bit tricky. It's something you have to get used to, and you watch it for a while. You trade it on our simulator or whatever. But for those that are mathematically oriented, which most futures traders are, it's not hard. It's not like gold or crude oil where the tick size is a dime or a penny and very easy to figure out. But well worth it given the opportunities for taking advantage of yield curve shifts. So let's say it's April 7th, again, the date that we record this. Trader believes the 2-year versus 10-year yield curve will steepen, and June is the front month and the 2-year futures as well as the 10-year too. It's now at about 150 basis points. What you would do if you thought that the steepening was going to continue, you go long the 2-year note, 2 of them, and you go short 1 of the 10-year. And if rates do go up, the 10-year the short position in the 10-year will gain more than you will lose on the long 2. And you do 2 contracts because the 2-year note doesn't move anywhere near as much as the 10-year note. So you have to kind of normalize. And it's a ratio that the clearinghouse recognizes. And if you see the margin calculation, you can see the margin on each 2-year note is $350. Well, you have to do 2 of them, so it's a $700 margin for that leg of the spread. The short 10-year note, the margin is $1,400. So the position gross margin is $2,100. But if you do this trade at CME Group, both products trade at the CME, and the clearinghouse always into risk mitigation. It's very important for traders too. You get a margin discount or a margin credit as they call it, and it's 50%. So the gross margin is $2,100, 50% margin. You'd only have to pay $1,050 to take advantage of any change in the 2-year versus 10-year yield shift. And remember, these are margins as of a couple weeks ago. Actually, I checked them today. They're about the same. So, but they are always subject to change depending on volatility in the markets. All right, so you can do this trade. If you believe the yield curve was going to steepen, you would do it just like it's on the slide. If you thought the yield curve was going to flatten more, you would do the opposite side of the trade. You'd go short 2 2-year notes and long 1 10-year note. As always, the CME Institute is a great place to learn. That we have a trading simulator where you can do Treasury futures and test your mettle. And also, pilots go through trading simulators all the time. Thousands of hours of trading on simulators, or excuse me, training on simulators before they ever fly a real airplane. So I urge you to do that too. And I think also we have a lot of free online classes. We have other tools, webinars, modules to help sharpen your skills and accelerate your learning curve. So go to cmegroup.com/education, and good trading to everyone.